In this video, I plan to introduce life insurance. Okay, and from the previous video, we talked about the risk of dying, okay, the risk of being disabled, and the risk of old age. And we said the number one risk was, risk of death, and we said the solution to that was life insurance. Well, what is life insurance? And you might be wondering why these pictures are here. Okay, well, life insurance is, let's say this is Mr. John, okay, and this is Mary, okay, and this is the agent, okay, this is you, okay. So this is you, an agent, this is John, this is Mary. They're sitting down, they're saying, okay, well, we're concerned that if John dies, or if Mary dies, then this family won't have sufficient income, that we won't have enough money financially, we will be in trouble. And so as an agent now, you're suggesting life insurance, and we're explaining what life insurance is. Okay, what is life insurance? Well, life insurance, the first thing we have to understand about it is that it's a contract. Okay, it's a contract. It's a contract between the insurance company, okay, to the insurance company and the family or the person here. Okay, so let's set up a plan for this family, and this is just an overview. I just want to be able to introduce life insurance. The insurance company in this contract will have a name, okay, and they will be called, I will use the color blue for this, the insurer. The insurer. The insurer, okay, they are the ones that are going to insure this family. Okay, now there's going to be a contract, and this contract is going to say, okay, if, let's say this is for John, life insurance for John, if John dies, okay, we will pay Mary $500,000. Okay, so this is the benefit, right? So this is what the insurance company is going to do for us, right? So we're basically going to, get them into a contract with the insurance company, the insurer, and we're going to get John some coverage, right? So if John dies, now let's kind of dissect this. Okay, so the insurance contract is saying if John dies, right? And so what if Mary dies? Well, they're not going to pay $500,000, right? This insurance is just for John if John dies. Okay, so I'm just gonna have this. So John must die in order for the insurance company to pay Mary. Okay, so here is green for money. All right, so in order for Mary to get this money, right, excuse me for doing this, but for Mary to get the $500,000, John must die. Well, what does that make John? John is now in the contract. In this contract, John is going to have a name. Okay, he is called the life insured, because the insurance depends on his life, right? He is the life insured. Now we could have had this the other way around, where Mary was the life insured, but the contract, this contract here says if John dies, if John, the life insured, dies, then Mary will receive $500,000. Well, what is this $500,000 called in insurance terms? Okay, well, this $500,000 is called, okay, the death benefit. The death benefit. So the insurer has entered into a contract whereby if John, the life insured, dies, Mary will receive $500,000 death benefit. Okay, now what is Mary then in this situation? What is Mary? Okay, so well, Mary in this situation, okay, because she's going to be receiving the money, Mary is called the beneficiary. She is going to benefit, right? he dies, she benefits. The life insured dies, Mary benefits. Now, if you thought that the insurance company was going to do this for free, well, you were wrong. Okay, so the insurance company is going to do this, but not as a favor, right? You must pay. Okay, the policy owner must pay. So whoever wants to own the policy, right? Whoever. Okay, so the agreement here is that John, okay, it could be anybody, right? It could be John, it could be Mary. Okay, the agreement is that John pays, let's call the company A, right? Company A. John pays company A, okay, $50 per month. Okay, so that's the agreement. It's $50 per month to get this coverage for him. Okay, now in this case, John is not only the life insured, he is also going to be, see this case right here, John is also going to be the policy owner. He owns the policy. What does that mean? That means he can cancel it tomorrow if he doesn't want the policy anymore. Now, Mary cannot cancel it because she's not a policy owner, right? But he is the policy owner. Now, we could have had it the other way around, where Mary was the policy owner, right? And this amount would be paid every month, and she can cancel at any time. Well, this amount that they pay every month, right? The $50 per month, okay, is called the premium, right? It's called the premium. So I know I've introduced a few things here, but if you notice, the middleman or the middle person between the company and the family is the agent. It's you. Okay, so again, let's just review the terms here. So we said the insurer, right? I'm going to use the color black. We said insurer, so that here's a contract. Okay, and there are much more, there's more than this that goes into this contract, but here are a few key points to start off with. We need an insurer, right? This is, company A in this case. Company A. Okay, we need a life insured, right? So if we go up here back again, if John dies, therefore the life insured, right? Okay, in this case it was John. Okay, we need a death benefit. Well, we agreed it was $500,000. Okay. Well, we need a beneficiary. Who's going to take this money when he dies? A beneficiary, right? Well, we said Mary is the beneficiary. Okay. And we said, who is the policy owner? Who's going to own this policy? And we said John is going to be the life insured, but also the policy owner. Now the policy owner is also called the insured. Okay, the insured, not life insured, but insured, because they're really getting insurance, right? They're the ones purchasing the insurance. They're the owner of the policy. Okay. Another name for death benefit, by the way, is face amount. Okay, don't let this confuse you. So face amount of the policy means death benefit. Okay, I'm just gonna write it here. Face amount, okay, is also death benefit.